Hey everyone, Bernard here. Welcome to part two of wealth management. If you tuned in to me yesterday on my live post, not sure if you noticed that my sign that I had that I was talking about, the rich people and how many there really are, that was backwards. And I want to see if anybody caught that because, I didn't even catch that. Didn't realize that, the camera when it's inverted shows things backwards, so I got to figure out how to do that. What I want to do today is, I want to talk about, what I did 2 weeks ago or a week ago from this past Tuesday. I spoke about a rich mindset versus a poor mindset. So what I want to speak about today is, why the rich get richer. I'm gonna show you the way the rich are able to maintain their wealth. Okay, so why the rich get richer? They have a financial growth mindset. Okay, so they're always thinking of ways to grow, not, stagnant. Okay, they network with other successful people. As I mentioned before, they hang out with the people that are going to get them to the next level. I use a bullseye as an example. You got the bullseye, the very center part, smallest part to hit is your center of influence. Your center of influence are only going to be those people in your life that are going to get you to the next level or going to be more supportive of you. They're the ones that you want to maintain in that bullseye center. Everybody else, you start going to the outer circle. So sometimes even the family is going to push into the outer circle above the bullseye because they're not the ones that are really going to get you to the next level. So this is the rich mindset where they're only going to hang out with those successful people. You also want to get outside of your comfort zone. Once again, as I mentioned about fear, fear is false expectation of appearing real. So fear is in our own head, okay? They do not run from fear, they attack it. I'm not saying they're not afraid. We all get fear. I mean, I'm sure they're worried about the coronavirus at the same time that we are, but they are more of a proactive approach. They just don't sit back and let fear dominate their life. So, they get out of their comfort zone. They go in to do the things that they don't like to do. We just, it's too hard. I can't do it. I left from being a chef 33 years into the financial industry. If you don't think that's hard, okay, I don't know what to tell you. It's pretty darn hard. But you know what? It's not hard. What was hard was me making the switch. And I believe in myself like you can't imagine, so I could do anything I want to do. And that's where a rich, that they get outside the comfort zone. They create multiple incomes of wealth. As I mentioned before, they need extra sources of income. So there's a few that I'm going to talk about. You have an active income, you have a passive income, excuse me, and you have an override income. Active income is you're directly working for money, okay? So you're working, you get a paycheck, that's active. Passive income is where money's coming in through, like real estate, use an example, rental properties or limited partnerships, where every month you're getting paid the rent, or every month you're getting paid on a mortgage from a property that you sell, or you lease out to people like me in the business, and we rent out office space. Override income is where I want to be. Okay, override income is where someone earns a compensation based on what somebody else did for the organization. They made a sale, they got a new person on board, and you get an override for it. So I always tell people, would you rather work 100% for you, or would you rather have 100 people work 1% for you? Okay, sorry, I want the latter. They invest, okay? There's savings and there's smart investments. A saving is nothing more than, putting money away into a safe place until it's needed. It's going to build little or no return. Except my apology when my lips get a little dry, so you'll see my Steeler cup soon. Smart investment. Okay, a smart investment is they put money where they know it's going to grow and it's going to have healthy returns. Okay, so they're going to look for the return on investment. They take calculated risks. They're not cavaliers and they don't have a cavalier attitude where, hey, let's just ride into the storm and just attack it face first. For investing purposes, they take calculated risks. Okay, they do the research first. They weigh out the pros and cons, and they base their decisions on what's going to bring their financial goals and what's going to help them get to that level, instead of just saying, okay, I'm just going to do that, and then that's just the way it's going to go, and I'm going to take a chance. Okay, they also focus on self-improvement. They're constantly learning. I mentioned that before in the rich mindset, poor mindset. So they're always constantly learning. They're always figuring out a way to better themselves. They're studying. And this is what I'm doing in my industry. I'm learning all this stuff. I'm bringing this to you as I learn it at the same time. Well, of course, I've learned it a little bit before. That's why I'm talking now. They never completely retire. And that's just because they love what they do. If you like what you do, it's not work. It keeps them going, man. They enjoy the feeling of success. They avoid overspending. Frugality is relative to your income, okay? Meaning that you're frugal. If you don't have a lot of income, you don't spend a lot. But as you make more income, you spend more. So they're very frugal. Where they make more, they don't spend as much, okay? They take time to reflect. At the end of the day, during the beginning of the day, they reflect on to how the day went, what they accomplished, what they did. It's similar to, you're learning from experience. You think about what you did and what happened, and what would you do or not do next time, or what would you do differently? So how would you approach the next day? You're never going to be rich, if I'm going to throw these out there. So these items here, there's my Steeler cup. You're never going to be rich if you focus too much on saving. Okay, so it's not always about saving. Becoming too frugal, it's not enough, because now you start pinching. You're saying, okay, I'm going to cut down all my costs. I'm going to get bare minimum. But you're never going to build significant wealth by pinching pennies and not spending on anything. Once again, it's the extra sources of income that are going to get you to that next level. So you need to focus on savings and earning. Okay, there's different streams of income. So it's the earning part that you do, and you're still going to do the savings. Okay, but you need to put just as much time into making money as you do saving it. You don't overspend. Okay, if you spend more than you make, you can never be rich. Okay, so you don't want to do that. So as your income goes up, your spending goes up, you're never going to get anything. So that's where frugality comes into play. Lack of financial control. You must avoid overspending. Okay, you accept the paycheck lifestyle. It's easy to get a job than it is to start a business. Having a job, it offers a steady paycheck. You get benefits. You might get pension. A job is something we're trained to do. A business is something you run, and you really don't know how to do it, and you go do it, and it's a little more challenging. They've instilled into our minds that and kind of brainwashed. We're brainwashed to believe it. You grow up, go to school, in college, pick a major. Hopefully you find a job in that field, work for 40 years or more, and then retire. Poor. Okay? I had the mindset. I made $150,000. Okay, I thought that was pretty good as a chef. Guess what? There's so much more out there. You start a business and you let the market dictate your worth. Okay, that's challenging. It's hard. It's a different mindset. But you can never be rich by working for a paycheck. Okay. Employers want to pay you as little as possible, and I know that me being a boss, being the chef, I only had a certain amount. I couldn't give anybody any more. That's all I can give them. And of course, I always wanted to pay them more, but I couldn't because the owners or the upper management would not let it. So, you get that mentality, you're just not going to pay. So if they could even pay you less, they will. Okay? How do I want to say this? You got to ditch the traditional paycheck lifestyle. Have to. Got to get rid of that. You gotta go outside the box. You gotta make yourself uncomfortable to be successful. Okay? For you to be successful, you have to be uncomfortable. You can't live in a comfort zone. You don't invest your money. All right? As we were talking about before, if you don't invest your money, you can't do it. That little bit of savings doesn't work. The investing part does. Most effective way to earn money is to invest it. Okay? Earlier you get started, the better. Does anybody have any idea when Warren Buffett first bought his first stock? When he started investing? Can't hear you. If you did guess, 11 years old. 20% of your income should be put away toward investing. All right. You don't challenge yourself. You're complacent. You go into the thing. You need to step out of one's comfort zone, as I talked about before. Are you so used to getting a mundane job? Go get a paycheck, go home, waste your time, sit down in front of the TV, watch Netflix. That's not going to get you to the next level. Okay, so always want to learn, always want to do, always want to grow. Get discomfort. Get uncomfortable to be successful. Okay, ask yourself. Are you the type of person that strives to make every aspect of your life comfortable? So as I was mentioning, get out of the comfort zone. But if you live in that comfort zone, I go get my job, I'm happy, I get my paycheck, I do that, you're never gonna be wealthy. Okay, it's not even the point of rich. Some rich people are not wealthy because they're too comfortable doing what they're doing, but they make decent money. Doctors, lawyers. Okay, wealth creation starts with one's comfort zone. Okay, you got to end it. Got to end at your comfort zone. That's when you're going to start your wealth. Okay, so once you step past your comfort zone, that's when you're looking for grounds of success. You strive for uncertainty, not knowing what the next paycheck is going to come from. That's tough. It's challenging, but you can make as much money as you want doing that. If you're optimizing your life for comfort, then you know what? You can kiss the wealth goodbye. It's just not going to happen. Comfort's not going to bring you wealth. Excuse me. If you don't have financial goals, you can never be rich if you don't have them. If you don't set your goals, you're shooting. It's like shooting at a target that doesn't exist, or you're never going to hit. It's just poof. Your arrows go all over the place. The bullets fly everywhere, so you're not hitting your target. So if you don't set those goals, you have nothing to shoot at. So how are you going to ever get wealthy, and how are you going to get rich? So you have to be able to set a goal before you can create even a financial plan. Once you set your goal, you want to write them down. Once you write them down, okay, then you have a course to get there. So now you want to write that course down to accomplish the goals that you want to achieve. Some of us out there, we don't even know what we want, wealth accumulation that we even want, let alone do we have any idea how to get there. So that's the key. Think about what you want, think about your wealth, and then think about, set your goals down, and then set your course how to get those goals. Step outside your comfort zone and go for it. Right? If you do not pay yourself first, as I mentioned before, about 20%, if you don't pay yourself first, it's never going to happen, okay? Don't pay all your bills first. Take whatever you make, take 10%, minimum 10%, okay? 20% is what you should, but minimum 10%. I take 5% and I move 5% into my capital investment for my business. Then I take 10% and I put it away for my own future wealth. If you don't pay yourself first, it's not going to work. A minimum 10%, and to make it easier on you, sometimes if you get a paycheck, you could have the company automatically deposit that into another account, but put it into an account that's inaccessible. That make sure you don't touch it, because this is for your future. It's not for other items. The rich also use taxes to their advantage. Okay, just to give you an idea, Warren Buffett, man, he's millionaire, billionaire, trillionaire, and he pays less taxes than his secretary. Okay, there's two types of taxpayers. First type, those that pay exactly what they're supposed to do, give the government what they want, they just believe that it's a normal thing to do. And then you got the second type, which is me, those that want to avoid all the taxes altogether. I don't know if you guys are out there, but I'll tell you one thing, I don't want to pay taxes. Our mindset is, a person who works hard for their growth. We started everything from scratch, we built our business, and why should we pay the government when the government did nothing to get our business growing in the first place? Taxable areas as a business owner, okay, these are areas that you want to be careful on because there's a lot of them. You got a personal tax, okay, you got sales tax, okay. Now the personal tax, it's also known as individual income tax. It's levied on wages, salaries, and types of income. Individual states also have state tax, okay. So then you got sales tax. This is a consumption tax. This is imposed by the government on the sale of goods and services. And we all pay sales taxes, so everybody's aware of that. The conventional sales tax is levied at the point of sale, and it's collected by the retailer, okay? And of course, it's passed down to the government. So the government has that one. You have an excise tax. These are narrowly based taxes. They're based on consumption. They're levied on specific goods and activities. An excise tax could be gas. You have property tax. Okay, this is a tax on real estate, corporate entities that you own, local governments and typical access properties. The amount of tax it's largely related to two things: where the property is located and how much it's worth. Then you have an investment tax. Okay, these are based on the income that comes from the investments, payments, dividends, capital gains, collected upon the sale of the security or the other assets. Any of the other profits made through an investment vehicle of any kind. So if you have any kind of investments, you get investment tax. So ways to avoid tax, writing off expenses. Okay, we all should be doing that. Business-wise, you have a lot more expenses to write off. Business expenses that are deducted from the tax purposes, they expenses, they're anything that's purchased that's going to run your business, for profit. So whatever you purchase on goes against the profit that you make, and it's going to help you in the taxes down the road. The cost of these items are deducted from the revenue, and then in the order is decreased for the total taxable revenue. Diverting income. This is the thing: is you want to divert income. You want to create income in areas that are tax havens. Is this challenging? Yes. We live in Nevada. Guess what? No state tax. Love it. Okay. Never go to a place again that has state tax. Now, as business-wise, we're thinking of other places because, as I mentioned, how many of those taxes were going to get imposed onto us, and there's probably even more. But we got to avoid as many of those taxes as possible. I'm going to give you one that I just found out. Cayman Islands. Cayman Islands is a tax haven. Okay? They have no corporate taxes. They don't impose any direct taxes whatsoever on their residents. There's no income tax, no property tax, no capital gains tax, no payroll tax, no withholding tax. Well, as I was saying, there's no tax. So Cayman Islands are one of the, they're considered tax neutral. Why would we not want to move our business there? Okay? That's the reason why you said, how come we don't do it in America? Well, that's one of the reasons why. As business owners, we got to save as much money. Why should we give the government what they didn't earn? Okay? Why we should give them what we earn? You want to netting your revenue against losses. This is where you get tax credits. So as you end up owing money, you could borrow against your tax credit. This is one thing that I'm structuring in my LLCs and through my corporation. So you're able to get tax credits. When you lose money, then you can sit there and as you owe money, you can borrow against your tax or your tax credit, and that goes against you for the next year. So that's a very thing where you net revenue against your losses. Issuing of stock options. Once you get really big and you start making it, what are you going to do? Sell some stock. That's a write-off. That's a tax write-off for the company. Okay? These are booked as expenses and they help lower your taxable income. Leveraging geographic locations. As I was telling you, that's a benefit. You want to find all the tax-free states you can do, different countries that don't impose so much tax. I'm not saying that's a good thing, but as business owners, you understand why we do that. Okay? You have it's all kind of stuff. Hold on, I'm going to get some water real fast. Excuse me. Investing in real estate. Okay? That's a personal benefit on that. You could, once you buy the real estate, you can write it off. You can write off part of your mortgage and everything like that. But if you buy the property and you sell the property, okay, then purchasing a home, that's tax benefit. But when you sell it, you got to pay the capital gains on it. But if you sell it again within 60 days, it's a 1035 exchange. Okay, so you can do it that way also. So you can get rid of that, and you can do that as an exchange. And I might have worded that wrong and all this stuff. But also deferring money into an IRA. This is us as business owners. We could take money that we would give to ourselves and we can put it into an IRA, and it's kind of like doing money into a 401k plan through a company. But we could do that ourselves as sole proprietors and self-employed individuals. So you can't exceed $57,000. So if you're 49 or less, the $57,000 is the most you can put in. If you're 50 and older, they call it a catch-up contribution, but you can't exceed $63,000. Okay, but once again, you're still going to get the ding. It's tax deferred. You put it in there, you're not getting taxed, but when you take it out, you will get taxed. Okay, and you still have to follow all the rules and regulations like a basic retirement plan. Can't take it out till 59 and a half, 71 and a half, you're forced. Okay? Tax occurs when money is taken out and follows as I mentioned to you on that. Okay? And I kind of showed you a thing, as I mentioned, I showed you yesterday, but it was kind of backwards. So I mentioned about being rich, the richest people in the world, and I have it over here, so as I looked sideways, I don't want to show you because it's backwards again. So you have the richest 1% of the population controls 48% of the wealth. Okay, 48% of the wealth. The top 80 richest individuals, they're worth as much as half the world's population, 3.5 million. Okay, only 11 out of the 80 are self-made millionaires. 69 of them had to build their own wealth. Okay, I'm working on that right now. Okay, and this is what I'm trying to get the mindset of people, that we all could be a part of this. There's no reason why these ones are the only ones doing it. If we have the same mindset, we step outside of our box and we go for it. And everybody knows, one of that 69 is Mr. Warren Buffett. Okay? Warren Buffett started investing at the age of 11. You could turn back time, go do it. But since we can't, let's go forward, baby. Okay? Rich mindset. You'll hear more from me coming up. I'll be doing some live coverages of people that I meet that are similar, with both mindsets and all that stuff like that. So once again, this is Bernard Barchi, CEO of Be Big Financial Solutions, LLC. And if you want to know what I do and why I do it, message me on Facebook. Okay? Until then, be smart, be safe, peace out.